So I was trying my best to keep it at 15 minutes, but it looks like I'm going to go over just a little bit though. So we were looking at gift cards when I got cut off on the last video. So gift cards, again, you sell a gift card, you don't know when it's going to be redeemed. So when you sell the card, you get cash, well, presumably, and you record unearned revenue. It's like we were talking about when we looked at this a little bit earlier. The product or the service hasn't been given yet. So it's unearned revenue. You've been paid in advance, basically. And then when the gift card is redeemed, you're going to debit unearned revenue. So that's it for that one. Then the next one, warranties. All right, so then we have warranty liabilities. So a warranty is up here. It kind of describes or gives a definition. It obligates a seller to pay for replacing or repairing a product. So often you can buy stuff, it'll come with a warranty, or you can pay for extended warranties and such. When you purchase the product, they record the warranty expense. Again, they don't know how much, or the company doesn't know exactly how much the warranty is going to be, but we can estimate based on past experience. And because of the matching principle, we want to record the expense at the same time as the revenue. So here, an example that was given is they sold a used car for $16,000, and it comes with a warranty, a 1 year or 15,000 kilometer warranty for parts and labor. Again, this car might have nothing wrong with it. It might be a total lemon and have tons wrong with it, but they know from experience that the warranty expense averages 4% of a car's selling price. So that's what they're going to use. So you're going to debit your warranty expense and credit your estimated warranty liability. If the person comes back with some problems and they need some work done on that warranty, then you debit your warranty liability, your estimated warranty liability, and you credit here wages payable and your auto parts inventory, as that's what was used. So again, it's estimated, so you have to kind of monitor it to see if that 4%, for example, I used here, they have to monitor to make sure that's a fairly accurate representation. If things start to go really different from the 4%, then they need to change their estimate. Income tax. That's the other one. We don't know for sure what the income tax is going to be at the end of the year. Something to point out, I guess, before we get into that is single proprietorships and partnerships don't have income tax. Those earnings are taxed by from the owners. So it's only corporations that we need to worry about income tax. Income tax, so it creates a liability until the payment is made to the government. So usually it's paid, usually what a company will do is pay their taxes monthly based on an estimate. Then at the end of the year, so it could be based on like what their last year's earnings were, for example. So, and what they anticipate this year's earnings to be then based on that. So each month, if you determine here, they determine that they expect to pay $144,000. So on a monthly basis, they record income tax expense and income tax payable. Then when they pay it, they're going to debit their payable and credit cash. We're going to do that right up until the end of the year. And let me see, did they show that? No. Oh, yes, we do. Here. At the end of the year, then, when you determine your actual liability, and instead of 144, it was 156.7. So in the last month, instead of doing the standard 12,000 every month, when they get to the last month and they know the amount, then they record the amount that's needed to make it balance. Maybe it wasn't 156. Maybe instead of 144, it was 140, and they'd have to lower their expense. But you use the last month to get it to the correct amount. And then we look at contingent liabilities. So it's an estimated liability. Sorry. I'm going to pause for a second. I feel a cough coming on. Okay, I guess you guys can't even tell I paused, but I had to pause and take a drink. All right, so the last topic is contingent liabilities. So here, the estimate, you can't really estimate when or if it's going to be paid or how much. So because of that, we don't record it as a liability on the balance sheet. It's something that's probably going to happen, but you don't know if, or you can't reliably come up with an accurate estimate. So they're disclosed in the notes to the financial statements. They go through a little decision tree, I guess, here. So you have a liability. Is it probable that it will occur? If it's not probable, or if you can't determine if it's probable, then it's a contingency. If it is probable, then you go to the next decision. Is it probable that the liability will occur, and can the amount be reliably estimated? If you can't estimate it, then you go back over here to a contingency. If you can't estimate it, you record it. The other thing is a contingent asset. So we're a little bit more cautious with an asset than we are with a liability. So contingent asset should never be recorded until actually realized. If it's likely or if it's very probable, then you can disclose it in the financial statements and in the note, but never record it until actually realized. Okay, I believe that is, yes. Okay, so that's it for the chapter summary. I'll be back now with some sample questions.